So the reason everybody can trust Bitcoin, from the US to Japan to China to the European Union, is because you don't have to trust anyone else. It's the one currency that is not manipulatable by a single government.
If you could ask Satoshi one question, what would it be?
I don't really care who Satoshi is, but it's like a curiosity, and other than that, it really doesn't matter.
We're back at Consensus Miami. Joining me is my co-host, Bonnie.
Oh, hi.
There you go, Bonnie Blockchain. And Mike Belshe is back with us. He was at our show last year. Check out the link down below to see Mike's interview with us a year ago. Mike is the CEO of BitGo. Welcome back to the show, Mike. Good to see you.
Thanks for having me back.
When am I going to start using blockchain banks, if you want to call them asset managers or digital wallets, instead of my traditional TradFi bank? Right? I'm just waiting for my DEX or even a centralized exchange to pay yield on a stable coin that I own. That's not happening now. Why is it not happening now?
Well, let's see, you put a lot of things in there. So first off, I mean, what is a bank?
Yeah.
BitGo is a bank.
Yeah.
So we are an OCC chartered national bank. But there's two types of banks out there. There's depository banks, which is what you're thinking of, probably what you use at home. And then there's reserve banks. So we're a reserve bank. So we hold 100% of our assets in reserve. Some just call it a trust or custodial bank. In terms of when are you going to see traditional banks, replaced, I guess, with a blockchain-based bank? Probably have a little bit of time, but this is coming pretty quickly. We do have stablecoins, of course. Stablecoins are a better deposit. They are lower risk. They are instant. They are 24/7. The fees are almost nothing.
Why do you say they're lower risk?
Yeah, exactly. People remember Luna, right?
Okay, no. All right.
Okay, that's very different.
Okay. Great. Sorry, I escalated that quickly.
Great question. All right. So just like there's different types of banks, there's different types of stablecoins, right? So when we talk about genius compliant stablecoins, the types that the BitGo can issue, these are one-to-one backed with very low risk T-bill instruments. So, it's called the risk-free rate in economics, which is, what's the interest rate you can get on a 10-year T-bill. And with the stablecoins, they're genius compliant, they're all that. So Luna was not that. Luna was an algorithmic stablecoin. Algorithmic stablecoins, much trickier. Not necessarily impossible, but not part of the Genius Act. So when we're talking about banking, we're definitely not talking about any of those today. And then maybe the last hurdle to get it exciting for retail is, how do you get interest to someone via stablecoin? And of course, we have the Genius Act, which says thou shalt not give interest to retail holders just for holding a stablecoin. Look, this is the wrong side of history. Eventually, we will definitely have stablecoins that can give yield back to retail holders. Right now, the traditional banks, some of the incumbents, are worried. They are worried that there's going to be a run on the bank and they won't have your money to lend out to others. So there's a little bit of a fight. There's no systemic risk. Some will say there's a systemic risk, but there's really not.
The rest of the world, outside of US, a lot of us are getting yield on our stable coins. 4%, up to 5%, 7%. What is the fight really about?
Well,
so you're not supposed to get passive yield, but it's okay to get yield if you, I don't know. What is
so
the
here
fight?
we are in the United States. We passed the Genius Act. So the good news about Genius for stablecoins, look, it provides some structure of, it should be a one-to-one stablecoin. It shouldn't be a Luna type of thing, right? It should be held by qualified issuers like BitGo as a national bank. Then, of course, it didn't quite get right, the interest. So we've got competing businesses. We got, on one side, you've got companies like BitGo, totally pro. Let's make sure people can get the interest. It's their money. Why should we be withholding it from them? On the other side, you've got traditional banks. You got the ABA, the American Bankers Association, out fighting, saying, hey, there's going to be a systemic risk. Everyone's going to leave the banking system and go to stablecoins, and then the economy will stop because we can't lend money. Well, this is false on multiple levels. By the way, we've seen this movie before. Back in the early 1970s was when we first introduced money markets, completely backed by T-bills. Again, they're pegged to $1. And they're backed by T-bills. They get you a T-bill rate. The reason this was interesting is because inflation was ticking up. So suddenly T-bills were getting to interesting rates. And back at that time, banks had a limit. There was a thing called Regulation Q on banks, which prevented them from having interest rates for their clients above a certain level. So the T-bill interest was higher. And they said, there's going to be a run on the bank. There was no run on the bank. There's no longer a regulation queue either. Everybody's happy. The banking system works. These are a valid part of our financial system products today. And everything's good. Really what's happening is just kind of people trying to preserve their existing business model because it's easier. But at the end of the day, it's your money. You should get an interest. You should be able to get a risk-free rate on it.
Why do you say we won't see a bank run?
Because not everybody's going to move. It's simply not true that everybody's constantly chasing simply the best yield. There's lots of things that you consider with your banking relationship. There's trust, there's checking accounts, there's services, there's lending, all kinds of things. Banks should compete along with stablecoin issuers and others to win business, and they can compete. One of the things that's happening today, like, most folks in the US are getting like 0.1% on their checking. So the risk-free rate, 4%. Like, wait, why is it that you're taking risk with your bank who's taking your money and lending it out? Sometimes they screw up, like SVB, and they're only able to give you 0.1%. Well, the reason is simple. The banks don't actually need your money. They've got plenty of cash. They don't really have good places to deploy it. They're not really the financial managers that they want you to believe that they are. I'll give you an example, back to SVB. The SVB guys had so much in deposits. They didn't know what to do with the money. They said, gosh, guys, we got all this money. What do we do with it? Now, you think of banks as lending it out. That's what they're supposed to do. They didn't have anybody to lend it to that they were happy with on the risk. So what did they do? They put it into 10-year T-bills, which, well, A, it blew up the bank. But if your only idea of how to make a yield is to put it into a 10-year T-bill, like, what kind of financial manager are you, right? Like, you are not worth my time. I can do that myself. I can use a stable coin. It works just fine. When I go to a bank that's supposed to be lending out the money to keep the economy going around, as they say, I'm expecting something a lot more than a 10-year T-bill product. So, look, we can talk about this probably for an hour, but I feel pretty strongly that the banks will compete with stable coins. They're going to have to start giving you a yield to compete with you, and it's going to all work out just fine. Right now, they're taking money from retail. They're using that to subsidize low interest loans for institutions and corporations. So again, it's an example of the big guy, beating out over the little guy because he can negotiate better.
So what you're saying is there won't be a bank run because banks will try to compete.
They'll have to compete.
But they don't want to.
They would rather just keep your money, of course.
That's the fight right now.
Yes.
Who's winning? What's really happening?
Well, look, when it comes to different types of industries and it comes to money, we have a highly regulated industry. The reason software hasn't had more of an impact on stablecoins and banking for the last 25 years is because of regulatory moats. And what's happened with blockchains is all of a sudden we're getting past some of those moats. The companies like BitGo, we actually are on both sides. We're on the blockchain side, but we're also fully into the traditional finance. We're a licensed bank here in the US, also in Germany, also in Dubai, also in Singapore. So we're able to defeat professors on both sides. But once software comes in, you start to have to compete. The banks have to compete. That's all.
Before we continue with the video, I'd like to address one of the fundamental problems of owning gold. Now, gold is seen in most cases as a store of value, but it has one major problem. It doesn't generate a yield in itself. And that's where today's sponsor, Monetary Metals, comes in. Monetary Metals introduces a model where gold can produce a yield paid in physical gold. Through their leasing platform, investors can earn up to around 4% annually, with yield paid monthly in ounces. That means your returns are measured in gold itself, not just in fiat currency terms. In an environment where many assets depend on price appreciation alone, this approach allows gold to serve both as a store of value and as a source of income. The metal remains your asset and can be redeemed at any time. Thousands of investors are already earning a yield on their gold through Monetary Metals, so visit their website today to get started and learn more. That's monetary-metals.com/Lin. Link in the description down below, or scan the QR code here and get your gold to start working for you now. On the insurance side, so I've interviewed Tom Honig, former vice chair of the FDIC before, and I asked him if he were still at the FDIC today, would he insure crypto banks or any blockchain asset manager? And he said no. He said, if I were still at the FDIC, I would make it a mandate to never insure crypto banks because I think crypto is a speculative asset. People are gambling. You want to lose your money gambling at the casino or at a crypto bank, his words, not mine. You have the right to do so, but the government shouldn't be beholden to your risk and insure your risk. How would you respond to that? What kind of conversation would you have with him or somebody like him today?
Well, look, I don't know if he said the government shouldn't be beholden, but like the government is not FDIC. It's supposed to be private. So if he used those words, he misspoke about his own product. But look, I'll ask you a simple question. Which would you rather use, an insured bank or an uninsured bank?
I would have used an insured bank.
Okay, well, when we're talking about an insured bank, which is written into the law in many places, what we're talking about is depositories. What do depositories do? They take your money and they lend it out. They take risk with your money to generate yield, help the economy go around, etc. Because they're taking risk, they sometimes fail. And this has happened historically many times. Eventually, we came up with this concept of FDIC, which is insurance for the banks because sometimes they screw up. So the insured bank is insured because he takes risks that need to be insured.
Yeah.
So like, which one's safer? A driver that has insurance or someone that doesn't drive?
Yeah.
Someone that doesn't drive. So look, BitGo is a bank, but we are a reserve bank. We're not eligible for FDIC because we're not a depository, Federal Depository Insurance Corporation. We hold the assets in 100% reserve. So we have them 100% of the day, 100% of the time. We could have a full bank run today and satisfy it all tomorrow. Show me a single depository that can make that claim. They can't do it because they don't actually have the assets. And of course, this is exactly what caught up SVB. Just use that example again. So look, I understand his concern about crypto. There's a lot of stuff going on in crypto that you can point out that looks fishy, but that's different than taking risk. It doesn't mean just because that particular crypto is risky, that all crypto is risky. So when we're holding 100% in reserve, it's less risky than any bank.
So in the future, traditional banks are going to do that as well. Is that what you're suggesting? They will have to.
They'll have to do what?
100% reserve.
No, I don't think so. So look, depositories do have a place, but I do think times are changing. So if you go back 150 years, we didn't have computers. You go to your bank and you want to get a loan, right? Somebody else goes to the bank. He's trying to keep his money safe. So the bank keeps safety for one set of groups, the depositors, and lends it out to others. You get a small business loan. The banker knows who you are. There's a lot of community around it. These days, banks don't really have the ability to mention lending anymore. They don't have a really good ability to do risk assessment. And on top of that, we have computers which make it global. So a great example of this is mortgages. It used to be you would go to your local branch in San Francisco, you would get a mortgage, it would be with your bank. Today, you go into your bank, he still underwrites it, he takes the paperwork, he checks your ID and all that. But by the time the door closes, he has sold it off to Wall Street. That thing has been securitized and packaged and is now liquid on the capital markets. It's a better way to do mortgages. And of course, ultimately, those all land at Freddie and Fannie. So banks aren't really doing mortgages anymore. What else do they do? Well, they do commercial lending and small business loans. Small business loans is often cited as a problem if you didn't have depository banks. Who would do the small business loans? I think there's some legitimacy to that, but it's a small cry from what they used to be providing in terms of service. So then on the commercial loans, let's move that to private equity. Let's put that on a blockchain. Let's make that open. Allow everyone to participate. So this idea that you have to couple retail deposits with institutional lending is a legacy. It's from the past. We can change that. And of course, blockchains are going to lead the way for them.
Would you consider switching BitGo to a fractional reserve model? Would that be more profitable for you?
No, that's not of interest for us. Like we're not trying to be a bank in the traditional form. So we're an infrastructure provider to anybody that's seeking to add digital assets to the repertoire. Sometimes that's banks that are depositories. So SoFi, for instance, is a great client of ours. They've got tokenized deposits. They've got a whole bunch of ambitions. Of course, they do crypto trading and a lot of other things as well. If you need stablecoins and those kinds of things. For us, the reason that we have the federal charter is so that our clients know that when you have money with us, it's at the utmost extreme of protection and safety.
Is stablecoin making Fed less powerful?
Is stablecoin making the Fed less powerful? I don't think so. So what are the stablecoins backed by?
Short-term T-bills.
Short-term T-bills. And who regulates that? The Fed.
But it's short-term. So the argument is that at whatever interest rate they'll have to buy, right? So that means the Fed's power, or like the traditional idea, is less powerful now.
Look, I don't think so. Look, the government has an issue, which is it spends money and it needs to borrow to keep that spending going. That has nothing to do with crypto. So to say that that somehow is to do something with stablecoins, even if we had no crypto and no stablecoins, the government would have to deal with this issue. And the problem that they do have is, you're right, short-term interest rates. That means they have to renew that loan in a year. They can't lock in for 10 years. By the way, people forget, but at the end of the Trump 1.0 administration, he was dabbling with an idea of a 100-year T-bill, right? And people are like, oh, that's crazy. But you know what? If we had locked in 100-year T-bills at that 0.5% or whatever it was back at that time, it was zero interest rate environment. It would have been a fantastic thing for the nation. We should have done it. Anyway, I don't think the T-bill rates has anything to do with crypto. Crypto, of course, can help satisfy some of that, taking some of that borrowing. If it does it short term, because that's what its clients need, that's what the government has to deal with. The government has to compete on interest rates with its T-bills against people that want T-bills from it.
We had you on the show exactly a year ago, just over a year ago, a year and 2 months. Looking at the chart here, we're currently at 81,000. Bitcoin surpassed $100,000 in November 2024. And then by March, it was just about 100,000 as well. What is the market not understanding about Bitcoin? If we believe that it's underpricing Bitcoin's true potential right now, it's underperformed the NASDAQ, it's underperformed the Mag 7 stocks in the last year. And it should be a high beta play, but it hasn't done that in the last year. Why not?
Look, markets are complicated and hard to fully understand, but the premise of Bitcoin remains strong. So unfortunately, the governments have a spending problem. It doesn't matter whether you're talking about the US or anywhere else. We spend a lot. And the way that they ultimately pay for that debt is through inflation. There's no way that we can pay back the debt by itself. The only thing that they can do is print money. So, we can stand here and we can try to predict when is that inflation going to kick off in high gear, and there'll be different answers. The market goes up and down, the economy gets stronger, gets weaker. I can't predict it exactly, but I think the thesis remains very, very strong. Another thing which is becoming more clear is that governments are becoming increasingly isolated. That is, the US and Europe, not as friendly as we used to be, right? Of course, US and China still pretty strained relationships. US and the Middle East, now very strained as well. How are governments going to settle between each other? It used to be on the dollar. Under Biden, he sanctioned Russia and then he stole billions of their dollars. Recently we've had dollars that were Iranian money that the US decided to take. You can argue whether that's good or bad. That's not my point. My point is, when the US has the political power to tells all other governments, hey, to find something other than dollars to use for your reserves. They have to have a couple choices: gold, very difficult to move around, and Bitcoin. So the reason everybody can trust Bitcoin, from the US to Japan to China to the European Union, is because you don't have to trust anyone else. It's the one currency that is not manipulatable by a single government.
Are you suggesting that in the future governments will settle in Bitcoin?
Absolutely.
I love that. Absolutely.
The Strait of Hormuz closure has taught us that Iranians wanted to get payment or bypass the dollar through stablecoins. So they wanted US dollar-backed stablecoins as well as Chinese yuan. So they wanted tankers to pay in either Chinese yuan or stablecoins, but they didn't accept Bitcoin, or at least not publicly. They didn't want Bitcoin. Maybe behind the scenes. What has that taught you? What has that experience taught you about Bitcoin as being used as a settlement?
Well, initially, I don't deal with Iran. It's a sanctioned country,
Yeah.
so obviously we're not allowed to do that. But the original reports were that actually they were taking Bitcoin. Now, there was also another thing, which was a seizure of around $350 million of Tether, I think it was. So remember, like any of the stable coins, it's underlined ultimately by T-bills and cash. So those are always confiscatable, in this case by the US government. When you're talking about CBDCs, whether it's from China or from the European Union, it's going to have the same issues. So what governments are going to learn is that they can't hold the currency of their rivals, because if their rivals politically decide to, they can take it away. And that's just always true. So look, I think that's why ultimately you end at Bitcoin as being the one that the governments control.
Will that put more pressure on governments to restrict Bitcoin transactions? Take the route of China, for example.
We will definitely see some of those moves, at least on a temporary basis, right? So anytime someone's got a control point, their first attempt is to try to defend that control point. It's kind of like back to banking. They're trying to defend the way that they do business now. So governments, some of them may decide, aha, I'll get rid of Bitcoin and that'll fix the problem. But look, this is ultimately about human beings. And go back to the first point, which is that every government that's massively in debt can only get out of debt by printing more money, which means they diminish the value of their currency at the expense of their citizens. When that happens, you always see a common pattern. The citizens have to go seek refuge elsewhere, whether it's in Argentina, Venezuela, Zimbabwe, the United States of America. The pattern will be the same. The people will go seek an alternative safe haven. There's not a lot of good alternatives in the US other than as to the US dollar. It's going to end up being Bitcoin.
Weaker currencies in the world. You mentioned Zimbabwe and all the Argentina. If more and more people around the world can access US stablecoin, what does that do to their local currencies?
Well, this is good for the dollar. So look, as much as we're complaining about the dollar is bar none the best fiat currency globally. So the US does have a great government, does have a number of protections for holders, investors, all over the planet if you're using dollars. Sanctioned countries, obviously a little bit of a fringe area for a bunch of reasons. That gets complicated. But obviously we've seen hyperinflation in many places that we mentioned, Zimbabwe, Argentina, etc., many times. And this is because governments often struggle to keep the balance of their currency so that it doesn't have runaway decline in value. Some countries have had this so repeatedly that they've already moved to dollar-backed or dollar-denominated dollars as their currency. So Panama uses dollars directly. El Salvador switched to dollars a long time ago. Other countries use hybrids, like in UAE, they use a stablecoin. Algorithmically backed UAE dollars backed by both oil reserves and US dollars. Hong Kong is 1-to-1 backed by dollars at US dollars at a ratio. So the US dollar is just the strongest. Many of these will fold, and then more will come into the dollar, which will actually prolong the good life of the dollar. It's good for America.
What could be bad for the dollar? What would cause a dollar sell-off besides the erosion of trust in the fiat system, besides an erosion of trust in the fiscal responsibility of the government? What else could cause capital flows away from the dollar?
A stronger China?
Would that be the reason?
Well, like you already answered your own question, right? I mean, the reason that the dollar will decline is erosion in trust. That comes from a couple of different things. A, are you printing it unreasonably so that you're devaluing it on your own, which is happening and is very visible. The other one is, can I trust that if I hold it, I'll be able to have it tomorrow? Russia and Iran obviously don't feel like they can trust it. Other countries also will worry if there's ever a political climate in America that dislikes them, will America just come and yank the dollars? So look, when you are the reserve currency, you have a responsibility to maintain trust, which comes on both of those axes. I need to know, no matter how much you disagree with me, you're not going to just steal my money. You violate that premise, I can't use you as a reserve currency. Number two, of course, you can't devalue my currency. China right now is not really a viable alternative. Look, China really struggles with foreign investment. It's not trustworthy in terms of they do not have protections for foreign investors like what the US has. There's a reason why the US capital markets are so much stronger, more than 50% of the global financial capital markets in the world, right? China's, by the way, capital markets, only about 25 years old, not very old. But moreover, like in China, foreigners can't own businesses, right? So there's major restrictions on what you can even do. there's also less trustworthiness in the financial reporting, kind of the way public disclosures are handled. So the U.S. is just stronger on all these fronts, which helps our economy.
I want to switch gears for a bit and talk about the IPO that happened earlier in the year. $212 million raised at the IPO. What can investors expect from the grand strategy that BitGo is currently undergoing, in which the IPO falls under? Yeah.
One of the troubles of being a public company CEO is I can't answer the question you just asked. So, I can't talk about what's coming in the future. I can't talk about statements that haven't been released. I can tell you why we're a public company.
Sure.
Look, I feel very proud of the team, getting to the public company status. The great thing about our U.S. capital markets, they do provide a high level of transparency for investors. And when you look at Wall Street, which is all coming into digital assets right now, they're looking at how do they pick partners to work with on technology, on regulated products, financial services, and they need to know that there's the nth degree of scrutiny on what we do. So our financials are all out there. You can see how we're performing. You can compare that to our competitors. Our competitors are private. Many of them are losing money. If you're going to be choosing somebody to work on financial services, you need to know that they're in a good, healthy state. So anyway, it's been good for us. The timing, I think, is really, really good. We're happy about the outcome and looking forward to continuing on the U.S. capital markets.
During your IPO roadshow, you said a lot of institutional investors kept on asking you about quantum computing.
Yes.
And what are they asking? What is your answer?
Yeah. So look, quantum computing is a concern. Some people are afraid that we could, in the not too distant future, have a quantum computer that cracks your Bitcoin or your other digital assets. Look, quantum computing is advancing quickly. AI helps things advance quickly. Personally, I think it's pretty far away. I think when you really talk to the cryptographers, there's no evidence of any near-term quantum attack against Bitcoin or other assets. However, it's a fear, right? And what are we talking about? We're just talking about trust in the US dollar. At some level, people have to be able to trust Bitcoin. They have to be able to trust digital assets as well. So this is going to continue to be a concern. Will there be a computer that can crack this cryptography? Maybe some period there is, maybe there won't be. Good news, we can develop, in fact, we have them, quantum resistant algorithms today that could be used for signing. We can put that into the Bitcoin protocol. We can put that into others. And then also even better news, I think really the emphasis on this in the last 12 months has really grown. The Bitcoin teams are working on it hard. The Ethereum teams are working on it hard. So I think in another year, this is not going to be an issue not because we're going to have quantum computers, but because we're going to put in defensive mechanism for it. So I don't think it's something people need to worry about much. But the next wave of entrants that want to come in with billions of dollars, they need to know absolutely that there's not a risk for their money.
Will Bitcoin take measures to make the custodian side of the business quantum resistant?
So we, as a custodian, we will do everything that we can to make sure that we're quantum resistant. By the way, at BitGo, even without having everything solved at the Bitcoin protocol layer, there's a bunch of things that we already do. We never reuse addresses. We make sure that when you're spending an unspent that's been exposed on its public key, that we can construct your wallet in the safest way so that you have minimal exposure. But as new protocol developments come in, we'll incorporate those too, for sure.
Last year when we were talking, I think you said the biggest concern is Satoshi's wallet. Is it still a concern?
It is. So for those that haven't studied this, Satoshi, who has about 1 million Bitcoins, and there's only 21 million that will ever exist. His coins were done at a time when the way we encoded them on the blockchain exposes its public key. And that public key makes it potentially exploitable by a quantum computer. So even though we will solve a problem so that everyone can move their funds to safe wallets, Satoshi might not be alive. We don't know why he hasn't moved his coins. He won't be able to move his coins. So Bitcoin has to deal with this debate of how to deal with that. What if a quantum attacker does get those coins? Look, I don't think this is a very realistic problem either, for another reason, which is that if you were to try to steal his coins, it's very noticeable very quickly, and the price of Bitcoin would tank. Most likely, it would be a white hat hacker, which would build the first quantum computer. they would use this as an example to claim quantum supremacy, but I think they're unlikely to try to steal it. Remember, if you try to steal somebody else's coins, even if you don't know who that person Satoshi may be, it is still theft. So you will be left with the problem of trying to launder the money of a diminishing currency. I don't think it's really a big practical problem, but I realize some people are worried about it.
Okay. Final question. What is the future of TradFi going to look like in relation to Bitcoin and blockchain? Is TradFi going to start adopting blockchain en masse? Are we going to see BitGos within JP Morgan, for example? Are we going to start seeing...
They're right over there. JP Morgan's right over there with a big display booth about their settlement on chain. So
what did you get right about the industry that maybe Wall Street hasn't adopted early on?
Look, to say we got something right, I would never use that wording. I think what it is, sometimes you see a technology, and as a technologist, I think I saw some value in it, and it's turned out to be right. But I think somewhat it's speculative. But the reason I was able to see it earlier is really just a higher tolerance for risk. So any technology when it's new is higher risk, and then over time you mitigate those risks. You change things. You go get regulatory licenses. You get insurance. You get backing. You do SOCA. All of these things. What's happened is it's had enough time where people are like, this actually does work. It does provide transparency. It can be done with cryptography, which protects us in a better way. And then now we've overlaid some of these other controls. So as we keep moving, the more and more conservative companies can participate in the asset class.
If you could ask Satoshi one question, what would it be?
That's a great question. Look, I'll first answer with a non-answer, which is I don't really care who Satoshi is. But it's like a curiosity, and other than that, it really doesn't matter. Maybe since I personally was fighting for larger blocks as a technologist perspective, I've never tried to take over Bitcoin, despite what some people might say. I would ask Satoshi what he thinks about the size of a block.
Could you elaborate a little more on that?
So look, Bitcoin doesn't scale very well. It's got relatively small blocks. There's a trade-off. As the block size gets larger, the propagation around the world takes a little bit more time. So some people really want to have really small blocks, so you can always run it on very small machines, which allows people to run it at home. So, as we increase the block size so that we can have more transactions in it, does it impair the ability to have it be as decentralized as it might otherwise be? So another question I might ask him is whether he had really anticipated that mining pools would be as big as they are. I think he might not have anticipated mining pools, but I'd be curious to hear his answer.
So why does that matter?
Well, mining pools allow one party to aggregate a bit more power than we'd really like. So as you know, you heard of 51% attack. You don't want anyone to have 51% because then they can control what goes in the blocks. With the mining pools, you have some of that possibility as well. Mining pools, they take all of the miners together. They make a nice steady stream of income. So it's actually a good thing for the miners and stabilization and steadiness. But on the other hand, the pool itself, if it ever gets over, even though it may have many miners inside of it, if it ever got over 51%, then it has control. So I think maybe he didn't anticipate this, but I'm not entirely sure.
That was very interesting.
Well, thank you. Yeah, I hope he can answer those questions to you alive one day. Yes.
I'm not sure I care.
All right. Great way to end. Thank you.
Thank you.
Thank you, Mike.
Thank you, Mike.
Thank you, Bonnie.